looking at what is happening if market is above some moving average, what is happening if market makes some move that is twice as big as the long-term average. This kind of understanding is important, and you can do it pretty simply.
So welcome back to the sound with Pavel Kycek. Looking forward to discuss a trading experience. 18 years of trading here, so looking forward to discuss. We're sitting down in Prague here, so welcome back. Actually, welcome to the podcast.
Thank you, Etienne, for having me here. Thank you.
I appreciate it. So let's kind of start with, tell me a bit more about what you're doing these days as a trader. Like, what do you focus on?
These days, I'm focusing on algorithmic crypto trading of crypto and stocks. We are running some service for institutional and retail clients in crypto, and on my own account, I'm trading stocks algorithmically, purely systematically. No discretion at all.
Awesome. So let's come back in time. Tell me when you started trading. What was that like? You told me you started trading at 18 years old. What was that moment like?
Yeah, well, I started trading 18 years ago when I was 18, basically. Right now I'm 36, close to 37. And yeah, it was a very normal way how usually people start trading. So I started discretionary trading. I was losing, honestly, for a few years because I didn't know how to do it properly. I was trying many ways, this kind of very normal type of trading, like double tops, double bottoms, with this type of trading, which was not working for me at all, as usual. So then I went through some research, and after a few years of trading, I went to semi-systematic, I would call it, type of trading, when I was trading basically mean reversion entries on E-mini indices and breakouts on crude oil. This fully discretionary, average holding time between 5 to 20 minutes.
Nice. So day trading, that's pretty interesting. What made you go to fully systematic?
Yeah, well, for me, discretionary trading was very, very psychologically demanding, honestly. And when my daughter was born, it was more than 7 years ago, I made complete switch. Even before I traded systematically, I would call it more like systematic investing, because my average holding time was about 30 days to 90 days. These types of rotational strategies on stocks, basically, and ETFs. So it was type of trading I used to be doing before my full jump into systematic trading. And when my daughter was born, I made complete switch because I wasn't able to support family, taking care of them basically, and also being fully focused on discretionary trading, because for me, discretionary trading is the toughest, the highest level of trading that one can do.
What made you stop losing money? You told me you lost money for a few years. What made you stop and kind of get profitable?
Well, primarily when I started being more systematic and started making some research, because I'm very data driven. I like understand markets very deeply. And when I saw that, for example, E-mini indices tend to mean revert on shorter time frames, then I was like, okay, maybe I shouldn't be trading momentum type of strategy on E-mini indices on 5, 10, 15 minutes time frame. Maybe it doesn't make that much sense. And then I also saw one trader that is basically who was combining this type of mean reversion trading with level 2 data, basically getting into the tape and trying to find nice entries on supports and resistances together with some overextended moves. And this was something that firstly started working for me.
Some people say that you gotta keep your discretion to make money, like to make better money trading. They cannot do it with like systems. What do you say to that?
I think both ways are doable. I would recommend everyone to start with understanding the markets first, because when I was a total beginner, it was only about making money as quick as possible, And because of that, I basically jumped the learning phase of what markets are, how they are behaving, what they are doing if something happens, what they are doing if they are in trends, what they are doing if they are in some sideways market or sideways movement. And if you really understand the probabilities, then you can trade discretionary if you want to. I don't want to get back like never ever, even though I would say that right now I would be much better discretionary trader than I was before, because since then I made a lot of research on daily basis and my understanding of markets is on different level than before. So I think that the biggest problem is that people push themselves to make money as quick as possible without proper understanding of markets.
Would you say if you trade systematic, you kind of give up some patterns like support resistance areas, like head and shoulders, short patterns, you cannot really trade them anymore? Would you say that's true, or would you say you still trade the same thing but in a different manner?
I don't trade these very basic patterns, but I do have some strategies that trade, for example, pin bars. But let me give you a perfect example. Most retail traders trade pin bars as mean reversion type of pattern. But if you make your research over a lot of data, you will see that it is working much better as failed mean reversion pattern, that you should basically trade against this pin in the direction of the pin. Okay. And this is what is working much better. And again, if you don't know it, you just trade somehow. That's why I'm always pushing research first. But back to your question. I don't mind that I don't trade these patterns at all, because I'm in market to make money, and I don't care that much if I will use support resistance or if I use some kind of patterns. I just want to use the best approach I can that is robust enough, that is made that way that it should survive in markets, and that's all I need. And to have as many of these approaches as possible in one portfolio.
Give me an example of maybe one approach to use, like very high level, for like how to trade systematically. Like what are some patterns you would look at?
Yeah, so probably everyone knows these very basic trend following types of strategies, like breakout of 50 days high, or breakout of all-time high, or moving average crossover. This is not exactly something that we trade, but these kind of logics work in markets, especially in crypto and on stocks too. It also depends what kind of market you trade. And on the other side, we are also trading one-day breakout based on, for example, the idea of Larry Williams volatility breakout, basically. So I tend to make a lot of research on very old models that we can see that they have huge data of out of sample, a huge period of out of sample, basically. Because especially in crypto, where we don't have enough data, we can play with 6-7 years of data. You have to know that your idea is robust and that it is not just an overfitted type of strategy on 5-6-7 years of hugely trending data.
You see a lot of new people now jump into cryptos because it's like the cool thing to be and like it's the cool thing to trade now. You traded a long time before crypto and then you moved to crypto. What do you think people do wrong when they go to crypto these days?
They think that they can make money very quickly, especially on small coins. But again, if you look at the research, mostly the smallest coins tend to pump and dump, because some favorite influencer is just hyping the coin up and it's falling to zero. So the biggest problem is that yes, crypto is for sure the least mature market and the least efficient market you can trade right now. That's why we are trading it a lot. But it is still efficient enough that if you don't know what you are doing, you will lose money. And people are here to make very quick money. That's why they are trying to leveraging asset, which average volatility is 10% a day, so it's definitely unnecessary. And they just over leverage. And in crypto, there are these types of moves when crypto can fall by 20-30% a day. And if you don't know what you are doing, you can be lucky and make a lot of money until this type of environment when usually these amateurs lose it at all.
Mm-hmm. So that's a bit complicated because, of course, ETF strategy is another market. Crypto, you cannot really test it too much, I guess, in the past. How do you make sure you have an edge with crypto?
That's a very good idea. That's a very good question. Sorry. So first of all, I'm always trading strategy that is tradable on different assets. It doesn't mean that I can fully take the strategy and use it, for example, on stocks or commodities, but it means that the logic, for example, this kind of breakout is working there, but I have to change exit because crypto is much quicker, so that's perfectly okay for me. Then every strategy is super simple, I'm always saying that I'm trying to be very simple on single strategy level and much more complex on portfolio level, because on portfolio level you can avoid over optimizing much simpler than on the single strategy level. So that's why most of our strategies have 2 to 3 conditions maximum, and they really are built with the so-called idea first approach, which means that I'm not data mining. I always know what I want to trade, because that way I know when the strategy should be working and when it also shouldn't be working. Plus, I do expect that some of these strategies will fail in the future. That's why we have in the portfolio 15 strategies, and basically then it is working slightly differently than if you are trading 1, 2, 3, 4 strategies, because then every strategy has the weight of 10 to 20% maximum of the portfolio, and I'm basically managing the whole portfolio on a higher level based on how the crypto market will evolve, because we know that it will get somewhere. If you, for example, check the cycle of immature to mature markets on commodities or on stocks, I love the periods before or during the tech bubble on stocks and commodities in 1980s, 1990s. These assets were moving like crazy, similar to crypto. And there you could see how the market is evolving and what will probably happen in crypto too, but much quicker because of the technology.
How do you manage a portfolio of 15 strategies? Do you kind of add risk to some, reduce risk? Do you turn off strategies, turn on some of them, or how do you manage it all?
Yeah, well, right now we are not turning off any strategies, but we are prepared for it. Basically, it is working that way that we trade 15 strategies, plus we have many different ones in so-called incubation period or incubation phase. It means that we run those strategies on our accounts only, and we basically check them on live market before we implement them to our clients. And for every single strategy we have in the portfolio, we have some benchmark. It usually means that we have different strategies or similar to those strategies we are trading live, and we build a benchmark for every single type of trading, for breakout, momentum, trend following, mean reversion basically. And based on it, we can compare the strategy we are trading against the benchmark. Plus, we also check how the strategy is performing in the environment we are right now. Give me an example, because I think it is super important to understand it. If you know when your strategy should be making money and when it shouldn't be making money, and these periods will be always in market, right, then you don't have to be afraid of drawdowns that much, because if the market is trending to the upside and your trend following long strategy is making money, then it is okay. If it is not making money or it is even losing money, then probably something is wrong with your strategy, and you should check it much deeper and see if there is not something wrong with this strategy. So we are managing it that way. Back to your question, that we fully understand what we are trading on single strategy level and portfolio level. We compare the environment we are right now, or we will be, with the performance of the strategy, and based on it, we are prepared to make some changes if necessary.
Some people will think that because you're trading systematic and automated, you need like a lot of filters. You need a filter for the trend, filter for this, filter for that. You say you only keep it to like 2 or 3 conditions. How do you make this work without too many filters?
Yeah, well, we work with maximum 1 filter. Usually or not usually, I would say 15% of those strategies use one filter, and another 50% of the strategies don't use any filter at all. You know, it is very simple to find some strategy that is working on past data. Unfortunately, we don't trade history, so that's why I tend to trade strategies that are not that sexy on the past data. They can go with 1 year, 2 years of sideways market, but because these are part of the portfolio, I'm a much more, I want much more the strategy to be and to trade exactly in times when we need them or when we need it to trade. So that's why, especially if I build a strategy for portfolio, I tend to go very simply, and I don't mind if the metrics are not that great on the single strategy level. So you, firstly, if you are a discretionary trader and you want to start trading systematically, I would say that the number one thing to change in your mind is that systematic trading should be very simple on single strategy level. You shouldn't try to put together all the conditions you were basically checking on the chart when you were trading discretionary, because it's very different type of approach.
I think the mistake is to go and copy what you do, like discretionary, to then trying to make it to an algo.
Exactly. Definitely don't trade cup and handle systematically, because it's not working.
Yeah, that's a good point. You mentioned you trade with mean reversion for crypto. How do you make this work? Because the market, you would think, is always like trending and like always going up and up. How do you add mean reversion to this?
Yeah, well, again, this is because we trend portfolios, and maybe I will repeat this word portfolio a lot, because to me it is the backbone of our trading. So we can have, for example, mean reversion short strategies in the portfolio because we have momentum long strategies. And we use mean reversion short strategies to get a different exposure in those times when markets are overexposed to the wrong side. And we know that exiting a trade, it's not the best option, because you know that people can be emotional much longer than you would expect. And especially in crypto, this is true. So that's why we have mean reversion type of strategies, and they work as a balancer or a diversifier, because the correlation to trend following strategies is very nice. It's about zero or even negative. So that's why we trade them. Plus, what is also important is that especially those small coins, because we trade the whole liquid crypto futures universe, which are basically up to 300 coins. We rank them based on liquidity, but basically the whole universe. So especially those small coins tend to be like pumped and then dumped by some influencers and so on. So there is huge inefficiency and even alpha in this type of trading, but it is risky. So especially in mean reversion type of strategies, you have to have lower weight or smaller positions on your capital, and you also should be in the position very shortly, like 1-2 days maximum. If the idea is not working, you should get out.
Tell me about the company you started. You now trade for people, you have a fund where you kind of manage capital that with people. Tell me how that works out and what made you want to start that.
We started 2 years ago. Firstly, it was a project for me and the co-owners of Robaxio, Dries and Deneb, because I'm not a programmer. I was trading and I'm trading stocks algorithmically, but not automatically, because I cannot program everything on the back end. But in crypto, it's 24/7 markets. It's very different to stocks, because there I just ran my scanners, and I'm running my scanners at the daily close or before reopen, and I just put the orders. It's 10 minutes of work, no problem for me. But crypto is very different, because in crypto, if the market is moving like crazy, which is usually the time when you want to be in the positions, you have to be very quick in your positions. So that's why I wanted to build my own solution for portfolio trading, and we trade up to 50, 60, 70 open positions in one time with very small exposure. It's not possible to do it manually. So I was basically trying to find people that would help me with it, and thanks to Twitter, we basically build a group of 3 people. we started building it, and after a few months, I made my due diligence, and honestly, I didn't see the same type of service we are running right now. So just then we started building the company about it, and right now we are fully in crypto, and we run the service for institutional and retail clients too.
Your exits are kind of different. You say you don't use stop losses, but you have a way to exit that's kind of particular. Tell me how that works out. How do you decide to exit the market?
Based on exit condition, because that's a very good question, and I could debate about stop losses in general a lot, because I think it is one of the biggest mistakes of many small traders. They tend to have very small stop losses, and they are just basically fake outs of market. For example, we are not using stop losses at all in crypto, but we can do it because every position has maximum 1 to 2% of the capital. The allocation is really very, very low, and we hedge most of our strategies with different kind of strategies, momentum ones, with mean reversion, and this kind of logic is in the portfolio. And what I'm saying is that usually you should build your strategy without stop loss, and just then add the stop loss, because if you run your research over hundreds and thousands of different strategies, you will find out that usually stop loss is worsening the performance. If you are trading, now don't take me wrong, if you trade with leverage, or your account is small and you want to take advantage of leverage and pushing it a bit, then of course you have to have your stop loss in the market, because it's about risk management first. But what I think is the biggest one of the biggest mistakes of retail traders is that they think about stop loss as an exit management tool and risk management tool, both. But these things are different. As a risk management tool, it's great. As an exit management tool, it's not that good. Let me give you one very short example. If you, for example, test your trailing stop loss, and you tested it that way that you would have your stop in the market, which means that once the price touches the stop price, you are basically out of the market. It is working somehow, and if you exit that way, that if, and you are trading on the daily time frame, if the market goes through your stop price and you exit at the end of the day, you usually, like 95% of all strategies you can test that way, will get better results. Why? Because lower time frames tend to mean revert, and it's valid everywhere on every market. So yeah, that's just one of examples how you can take advantage of the volatility and mean reverting type of characteristics of basically any market.
Interesting. So if you have a wick that kind of stuff you out, you wouldn't be out of the trade. You would still be in the trade because price goes back in your favor after.
Exactly. Yeah. Or you can exit anyway, but on the daily close, for example, or 4 hour, based on what time frame you trade. But it's always better statistically that if you have some stop loss, the price goes through the stop price, and you don't exit, but you exit at the close of the price or of the bar, you will get better performance on average.
Wow, interesting. That's good. So what about take profits? Do you have any kind of take profit to closing trades when they're in profit, or do you wait for them to fall back to?
Yeah, well, we don't just take profits at all. Yeah. Again, I don't think it is bad approach, but it depends on the asset you trade, and it also depends on how you trade in the terms of if you trade just one strategy or again the whole portfolio. I'm trading momentum type of strategies, and for momentum strats, profit targets are again not the best approach how to exit the trade. So we are using like time stops, which means being in a trade for X days. What we are also using is this kind of exit in the market. For example, for breakouts, what is very nice condition is that if, for example, is close above the previous day's close, you get out of the market, because you are again getting out of the market if the markets are somehow overextended shortly. And in general, we are trying to use exits that reflect markets more, which is usually not profit target.
Interesting.
But for example, for mean reversion type of strategies, profit target is definitely one of possible exits. But again, to stress one thing, especially in crypto, we don't have enough data, and I don't want to over-optimize strategies on just 5 years of data and say, okay, 7.6% profit target is the best one based on last 5 years, because we know that crypto definitely won't be similar in next 5 years.
Interesting. So tell me more about the time stop. So because a move could happen very fast, then it could happen like over a certain number of days. How do you determine that kind of time stop for your trade?
Yeah, it depends on the logic with which you enter to the market. For example, this is working great for very short type of breakouts. For example, on the daily time frame, if you know that you want to catch some initial move only, but you don't want to stick with the position and change it or continue with the trade as a trend follower, then using these time stops, being in the market 1 to 3 days is working very nicely, and it's made on a lot of research, especially on commodities, because I used to be trading these kind of breakouts on commodities too, and usually these type of very quick moves tend to mean revert after some time. So you have to know if you want to build trend following type of approach and sticking with a position for another 1 to 3 weeks, or you just want to extract this very short type of movement after the initial breakout.
Interesting.
So it is really about the logic you are using for exits, for entries, because to me, I know that there is the debate what is better, if exit or if these are exits or entries. To me, it is always connected, because there are definitely entries for which there are much better exits than for others, and that's why you have to think about it as a complex.
Now you're on Twitter, you get people probably reaching out to you and telling you about like the stories of how they lost money, how they want to get profitable with trading. What do you see as the common mistakes people make in trading crypto or like any kind of trading in general?
They start trading too early with their money. They don't understand the market in general, I would say, and they don't understand risk management. And I would say one thing that people are not thinking about it much. I'm in the market to take their money. You are in the market to take someone else's money. We are in the market to make money, and this is not the place we can just extract profit. It's competition. So you have to think about trading as a competition. It doesn't mean that it has to be super difficult. In fact, our strategies are pretty simple, but you have to understand the market, because if you don't understand how the market is moving, what does it mean that it is trending? What does it mean that it is sideways based on your strategy or your strategies you are trading? You will have very tough times when you will go through the drawdowns, because this is probably one of the biggest mistakes traders do. Even though they have some approach that could be profitable, if they have this approach, then they don't stick with the solution during the drawdown. And it was my mistake too. I think everyone made these mistakes in the past. Don't get me wrong. It's tough. Drawdowns are always tough. I'm in trading for over 18 years, and I'm definitely not enjoying drawdowns. But again, if you understand what you are trading, you can get back to data, for example, if you trade systematically, and you can check what is happening, and if something like that happened in the past. And if it did, you are pretty okay. You just have to be focused and disciplined and stick with the solution.
I mean, drawdowns with trading discretionary is tough, because you always it always impact how you trade, always impact your next trades. So when you trade systematic, it's easier because you just have to rely on the system. That I think is a lot easier for sure.
Yeah, plus emotions, of course, especially in discretionary trading, emotions are huge, and you have to work on it a lot, because being disciplined during a highly volatile market, if when you are always under some type of emotions, especially if you are trading intraday, because I would say that intraday discretionary trading is the top elite type of trading you can choose, so you can behave that way. Probably it is not the type of trading you can do at night after your children go to bed and you were working 10-12 days at work, because again you are against the biggest professional that are trying also make money there.
A lot of people would say then, well, trading is just like a zero-sum game. Then how do you explain that?
I'm thinking about it because if you check some research, and I'm really research driven, it is not like completely zero-sum game, but I'm thinking about it in that way that if you lose, or you have to lose for me to make the money, and I'm always saying it because people don't understand it that much. Like, market is not there to give them money. You have to have your edge. Firstly, this is the most important thing. You have to know that you have edge over the other market participants, and just then you can even start thinking about making money. But it's long-term journey. It's I would say that you have to understand quite a lot of things before you can be comfortable in trading and in drawdowns and with the volatility and so on.
How do you go about understanding the market? Because it feels like you could read a book about it, or like you could watch videos about it, but is that enough, or do you need to learn something more about the market?
Books are great. You have to know which books to read. So I always recommend books from algo traders who have some proven track record. For example, Nick Rage is great, but there are others. Lawrence Berstov doesn't matter that much. In fact, I would choose algo traders because based on what they are showing you, you can again understand the market, and then you should always start your own research. It doesn't have to be that complicated. People are often afraid of it, but the start can be as simple as download the data from Yahoo, for example, open it in Excel spreadsheet, and looking at what is happening if market is above some moving average, what is happening if market makes some move that is twice as big as the long-term average. This kind of understanding is important, and you can do it pretty simply.
Like going back in time on the chart manually.
Yeah, exactly. Even if you want to trade discretionary, I think you should understand the market on data. But that's my way. That's how I can confident in the solution, and how I can even offer it to our clients.
What I realized over the years is that a lot of traders, like you can of course trade by yourself and like do all yourself, and it's good, but a lot of good traders have teams around them. Like you have coders who can help you coding things. How did you kind of find that team?
I would use social media a lot. It's helping. Talk to people that are trading. In my example, it was really about Twitter. I just went to Twitter with the idea that I want to find someone. So I started giving away quite a lot of free stuff, quite a lot of ideas and logics, and I was really aiming for the idea that if I will give away good stuff, someone will see that, I know what it is about. And it just came. Dries found me out through some free trend following strategies I was giving away, and we started building the team. So I think you have to know what you want to get. It's very important, even in life in general, I would say.
Yeah, because imagine you got to do all the trading, the coding, and everything. It's just a lot of work.
I wouldn't do it. I know that I wouldn't be there without my team, or not my team. These are co-owners of Robuxil. So because I can program in a way that I can program my strategies, my portfolios in some backtesting platform. I can do one or two things in Python, and I can work with macros in Excel, for example. So I can test everything. But what I cannot is build automated engine that is able to trade. And don't take me wrong, we were working on it for 2 years with firstly 3 people, and right now we are contracting another 2 to 3 programmers. So it takes time, and usually people underestimate how much time automated trading takes, because I don't think retail traders who want to trade systematically should aim for automatic trading, especially if they want to be more advanced, for example, trading many positions. I think on most markets it is doable like mechanically, like I do on stocks, for example, but in crypto it's hard. It's you cannot do it with full automation, because you just have to be very quick there.
Tell me about the transition from trading your own account to then trading capital for other people. Was that a big transition? Was it hard to do, or was it easy to go from like trading for fun?
It wasn't that hard, because I had it in my head for a long time. You know, it wasn't that I woke up one day and I thought, okay, let's start trading someone else's money. Firstly, we knew that the solution has to be really institution grade, because from the start we were thinking about offering the solution to institutions too. So it was really about trading on our accounts, making all these mistakes on our accounts, building, getting the confidence that what we are trading is what we should be trading, because it is not always the true with automated trading. Oftentimes people don't even know that they trade something different than what they back tested, because the logic can be, for example, slightly different. Okay. So yeah, in our case, it was something we were preparing for 1.5 years. And I always wanted to trade this way, because it's about leveraging the capital and leveraging the edge you have. So it makes sense to me.
Does it add any kind of pressure to you as a trader to kind of perform better, or?
I would lie if I would say that there is not bigger pressure. There is, but because we are trading systematically and automatically, and we tested everything 1,000 times, the pressure is much lower. And what also helps is that, and almost every one of our clients knows what our solution is about. They know that we can be in a drawdown for a year without problem. They know what the expected drawdown is. I'm trying to be with them in touch through YouTube videos and through bi-weekly newsletters. So I'm really trying for a client to understand the solution, because if you don't understand what you trade, and it's always true, doesn't matter if you trade other people's money or your money, if you don't understand what you trade, you won't stick with the solution long enough to make money over the long term.
A lot of traders that have a fund, they always see people want to get out of the fund like at the worst time, in the drawdown. Do you see the same thing happening? People want to get out when it's like a drawdown happens, or?
What I see is that people are getting excited when we are performing well, and then usually some type of drawdown happens. You know, so this is something that I usually see. But it's true that Murphy's laws are working in trading. So if I'm implementing new strategy, for example, I always expect that I start with drawdown, because I don't know why. Don't ask me why, please. But usually I'm always starting new strategies with drawdown. It was also very good idea, not mine. I got it from one hedge fund manager. Is basically waiting for some type of lower drawdown before you start trading the strategy. It's good because you are psychologically somehow prepared that if the strategy is not working and it's getting into bigger drawdown than expected, you can switch it off. But you are at least halfway to this metric. So yeah, it's working.
Have you ever turned off strategies you go live with, like because they don't work from the start? Or let's say you have something new and then you trade it for a while and then it doesn't work at all?
I did both because in the past I was playing also with data mining type of strategies, in terms of that I had an automated solution that was basically trying to find some strategies, and then they went through very tough robustness procedures to know that the strategy is robust enough, but it didn't work, or don't take me wrong, it could work, but I wasn't prepared for this type of trading. So I switched this solution completely off, and I returned back to idea first type of trading on daily time frame, which is giving me a lot of comfort, because if you are trading some very short time frames, you can have very good strategy that is performing well, and the performance can stop and turn to the south very quickly, especially on 5-10 minutes time frame, because the edge can be arbitraged out pretty quickly. But if you are trading on daily time frame, then usually if the strategy stops working, you get into some type of plateau when you can switch the strategy, you can change it slightly, or you can just keep with it if you can see that it is perfectly normal. So yeah, sometimes I'm changing strategies, but it's the frequency is like 1 a year or something like that. I usually tend to add strategies to the portfolio.
At what point is it too much? There are too many strategies. Is there a point where like you have to take off some to add new ones, or?
Good, very good question. Right now, we are in the state that we want to add strategies that has some diversification effect to the portfolio. It doesn't have to be a correlation like 0 or 0.2, which means that they move totally differently to any other strategy, but it should always be a strategy that by logic should make money in different periods, in different market behavior than the other ones. Plus, what we are aiming for is spreading the liquidity too, and that's why we don't mind adding more and more strategies. But for example, if I would find some strategy that is robust and is performing in very similar periods than other strats in the portfolio, I wouldn't mind change the strategy. It's trading, and once you have many strats in the portfolio, you are really managing the strategies, and you don't have to be afraid of playing a bit with them. I'm not saying about changing it every month. The frequency we are talking about is 6 months or once a year or something like that, because especially on lower or on higher time frames, you should be much more disciplined in terms of that you should stick with your strategies long enough.
Interesting. A lot of newer traders have like really high expectations for return. They want to get to like a really high like return per year. Do you have any kind of target you aim for? Do you have any kind of expectations that are different? What do you kind of see as the returns you aim for?
So firstly, I don't have any expectations on yearly basis, because I don't know how market will be behaving. And now, don't take me wrong, I'm in the market to make money, so I want to make as much as possible with some good performance to volatility of the account ratio. But I do expect some performance if the market is behaving somehow. Let me give you an example. Since September, crypto was in some nice long trend, then it went sideways, and then small long trend again, and our clients made between 60 to 110% based on the portfolio they are trading. I can have this type of expectations in crypto, because crypto is very volatile and very inefficient. On stocks, my expectations, so in crypto, I can have an expectations of over 100% even, especially in good years, it can be even more if you know how to trade. But in stocks, my expectations are about 15% long-term average, maximum.
Does that mean that everyone should trade crypto because the returns are higher, or should people stay away from crypto instead?
I think if people wants to go to crypto, it is pretty good time right now, because we can see good ratio in terms of performance. Crypto is still very volatile, but the risks are much lower. There are always risks, because if you have somewhere huge profits or a huge potential, then there has to be some kind of risk. So right now, crypto exchanges are much more regulated than before. So this is still one of the biggest risks. That's why our clients spread accounts across among many exchanges. And another huge risk is being too leveraged or too exposed to one crypto or one coin, because it can happen very quickly that some coin can fall to zero without basically any liquidity. So you have to be prepared for it. There are very different set of risks, and you can make a lot of money there. But if you don't know what you are doing, probably you should learn on some other asset, and you should move to crypto then. But you shouldn't wait that long, because we see it on every immature to mature cycle on any other asset, that firstly every asset was hugely volatile, hugely trending, many inefficiencies, huge opportunities to make money, which is crypto right now, and in the past it was even better. And then you are basically arbitraging, or the market is arbitraging the inefficiencies and the volatility out of the market as the liquidity is growing, and the potential is much lower. Can I give you one example? For example, let's look at Bitcoin. I'm always making some basic research on every asset to understand what is the direction of the asset. For example, Bitcoin. Bitcoin is trending very similarly to what it was trending 5 years ago, 7 years ago. The trends are very clear, very clean, but the volatility is 30 to 40% lower right now than 4 or 5 years ago, and we can see that there is a trend, that the volatility is getting lower and lower over the time, and we can expect something like that. I'm not saying that it's for sure. In markets there is nothing for sure, but highly probably also compared to other assets, this is something that is happening and that will continue. So then I have to expect that the potential of profits will be lower and lower, and this is also the reason why we trade the whole universe of tradable crypto futures, because Bitcoin has long-term volatility about 1.5 to 2%, let's say, but the small altcoins, they can have between 5 to 10%, so that's great, especially for traders.
How long do you think until crypto kind of becomes more flat or like less volatile?
That's a very hard question. What I do expect is that we can see that in crypto, the regulation is getting better and better. Basically, crypto market will be regulated, at least in Europe, in 2 years, thanks to MiCA regulation, and it is happening everywhere around the world. And we can also see how institutions want some exposure to crypto. We can see it also on our surveys, and that they are interested in what we are doing. So I would expect that in 3 years, crypto will be much less volatile than it is right now. I would say 30 to 40% less volatile, but it's very rough estimation. What I I don't want to use word correctly with market, but what I expect is, and I can see it on trends, that crypto will be for sure less volatile over the time. It's for sure, but how quickly it will happen, it will be connected with regulations, because big hedge funds don't or cannot even make exposures, some of them, or some institutions. So this is something we as smaller traders can take advantage of.
Sounds cool. We covered a lot in this interview. So tell me, where can I find you or connect with you after this podcast if they want to reach out?
Yeah, well, you can go to our website, robaxio.com. If you want to know more about our service, just go to robaxio.com/explainer, where we explain how everything is working. And if you want to follow me personally and my ideas, just go to my Twitter account, handles Kycek, P-K-Y-C-E-K.
Awesome. I'll put a link below for that. People check it out and connect with you there. Appreciate your time and the advice to give here. I think it's been pretty insightful. People can get some value out of this, and hopefully they can connect with you and see what you're doing out there. Appreciate it.
Thank you. Thank you, Etienne, for having me here.